Well, hello everyone, it's Russell here from Enhanced Asset Management, and I would just like to share with you today a few of the big macro themes that we continue to watch very closely for, as we don't need to tell you, the world economy has been an incredibly volatile place over the past few years. So in that light, I think it's important to understand how we got here and on that basis, how these macro themes have developed over time. So to illustrate that, this first chart shows three measures of inflation that we've chosen, coupled with US interest rates in the orange below. Then we show on the left-hand side the first grade shaded area, which was a global COVID shutdown period, which initially started to push up inflation. Now, this was owing to very fragile supply chains, which businesses and consumers, really fought aggressively for any goods and services they could get their hands on. Then the second grey shaded area in 2021 with the Russia and Ukraine conflict, which is still ongoing. These guys are huge exporters globally of commodities, and this really kicked off inflation, as you can see, with it running about 9% at one point. Now, thankfully, over the last 10 to 11 months, we were given a bit of a breather with the situation, and it began to normalise throughout the economy. But of course, nothing ever sits still, and now we're faced with the Israel-Gaza conflict, which by themselves, they're not huge global commodity producers, but some of their neighbours like Iran and so forth are, and there's genuine fear that the regional conflict may spread again, which is again pushing up and refueling inflationary expectations, which is the third grade area on the right, and you can see a little bit of tick up in those line charts here. Now, throughout all this time, financial markets and central banks have done what they typically do, and that's use a very crude tool with interest rates to lessen economic activity via dampening demand-side pressures. And you can see this in the orange line down here below, which has been a steady march higher since 2020. Now, if we zoom out a little bit, we can show how unique this period is, and we can also see how the tensions are possibly disrupting the current trend lower in inflation. But we can also see that what we're living through is something that has not happened since the early 1980s, and that's shown on the left-hand side, when inflation and interest rates, were north of 15%. So let's hope we don't ever get there again. Now, it's ultimately this volatility that has and continues to make its way into global asset markets, with the recent equity pullback being at the center of attention for a number of our clients, and for good reason. But I guess what we hope to impart on you today is that these asset price corrections are the output of what continues to stir underneath and what we've all faced. That's inflation, and therefore the gravity-like impact that interest rates are having on all valuations across all markets globally. And we can show that on this chart here. Now, it's not all that's mattered over the last 2 or 3 years in share and bond markets, but it's about 95% of the picture. Across different parts of the US equity market, as well as bonds, for example, valuations and hence returns have been crushed. Small cap indices here are at their near cycle lows. They're priced for a recession. There's clearly one exception, which we talked about in our quarterly recently, and that's the Magnificent Seven, the big tech names, which have benefited from the AI hype thematic. And as was discussed in our portfolio positioning, we've taken this advantage with everything else falling around behind them to take some risk off the table and lessen our positioning there. So in this next chart, we can clearly show the impact in a more concise form. Now, in a period of stable inflation interest rates, almost 10% annual returns were delivered. Now, in the period that we've just been through, the last 2 or 3 years, the difference is pretty striking, just 2.5% annual returns. So here we all are. Valuations have been under intense pressure. Inflation has got away from central banks. They've reacted with interest rates. Asset prices have fallen across all asset classes, delivering very low returns. And that's what we've all been through. There's just been no escaping that. But what we need, therefore, is a period of stabilization. And looking longer term, as we show here again, shaded in grey, it appears to us that we're at the very tail end of this tightening cycle, assuming conflicts don't increase and drive inflation up to 9 or 15%. We probably have less than 6 months to endure, which is a very positive development. So, I bring you some positive news today. So, hopefully you find that informative. But for all us here at AM, we hope this update finds you happy and healthy. That's all for us.